los tiempos, pero ahora ya sí puedo saludar a Jay Pelosky, fundador de TPV Advisory. Jay, thank you so much as always for having us these few minutes.
Nice to see you, Mara.
Jay, I would like to start with a question about possible mixed signals now in the US economy. I don't know if you share this vision, but for these weeks in late January and in early February, we saw how the US economy seemed to have reached a rare sweet spot with inflation steadily slowing from this painful hikes that we saw in 2022. Growth, hiring remained surprisingly steady despite these interest rate hikes from the Federal Reserve. Do you think right now the US economy is sending to us these mixed signals?
Well, it certainly would seem that way from the data, Marta, as you point out, but I think a lot of that strength in January is overstated due to weather. We had a very warm January across the country. I think it was maybe the 5th warmest January, and so that really boosted a lot of activity levels, particularly car sales, home sales, things of that nature. So I would expect that economic data to kind of show a cooling off as we go through the first quarter. And over that time period, of course, markets have reacted quite aggressively, particularly on the fixed income side, as that hotter than expected weather and data led to the fixed income markets pricing out a recession, pricing out the idea that the Fed was going to cut rates this year. So we've had a pretty significant repricing in the fixed income market, which has certainly caused the equity rally of January to pull back and kind of consolidate, which in our view at TPW Advisory is actually a healthy outcome.
Jay, do you think a soft landing is still possible in the US because doubts in markets persist right now?
We've always going back to the summer of last year, about a middle way. We called it a middle path between high inflation and deep recession for the United States and globally. And we continue to think that that path is kind of opening up before us. We expect inflation data to be considerably lower on a year-over-year basis as we move through the next several months. Remember that February and March last year was when the Russian invasion occurred, and we had spikes in both energy and food prices. So we expect those comparatives to be quite favorable as we move forward. And then in the second half of the year, we expect shelter costs to come down dramatically. We already know that's happened in the data, real-time data, but it takes time to feed into the CPI structure here in the United States. So on the inflation side, we feel pretty good that inflation is going to continue to decline. And on the growth side, we continue to feel like the economy is okay. It's not going to be strong growth, but it's not going to be a recession. There are no major imbalances in the US economy, whether you look at consumer, corporates, or the banking sector. And so that suggests to us at a time of record low unemployment that the economy, which is 60 to 70% consumption, is going to do okay. And we feel that way globally as well.
And Jay, we've talked in terms of investment. Which opportunities are you focusing in right now?
Yes, it's interesting. We had that I mentioned a minute or two ago, and that has allowed certain prices to go from being overbought after January's strong start to kind of oversold. And parts of the emerging markets, which we've been keen on since last fall, would fall into that category of being oversold, including in Asia, particularly China. China's had a pretty significant pullback. We continue to think that Chinese growth will lead the world and will begin a new global growth cycle as we move through 2023 into 2024. So there's an opportunity with that pullback to buy Chinese equity. We think right around current levels. We think gold miners also have pulled back and are appealing given the spike in interest rates. We think that spike in rates is pretty much done. Bonds are now oversold. So we're at a point where these interest rate hikes are probably going to come to an end. That should be good for things like gold miners, base metal miners as well. The commodity space broadly, including energy, remains attractive to us, as does Japan. And in the United States, we think things like biotech, small caps, and industrials are attractive, as well as home builders, which had a big spike in January and has come off maybe 10% or so, 8 to 10% so far in February. And we continue to think that the housing market in the U.S. is bottoming, and so we like the home builders as well.
Jay, thank you so much for this analysis, as always. A pleasure.
Thank you, Martha.